Spotting bubbles is everyone's favourite game at the moment. Fierce debates rage as to whether there's a bubble in the bond market, with junk bonds and leveraged loans in the spotlight, in social media and biotech, or in just absolutely everything from art to London property to equities. Now, bubble deniers justify current market complacency by pointing out that shares have been far more highly valued in the past, and there's really no sign of the insane enthusiasm which has accompanied many previous bubbles, most recently the dot-com boom. Defining a bubble is pretty tricky though. Jeremy Grantham at GMO has perhaps the simplest definition, looking for a move 2 standard deviations above historic norms. On this basis, the S&P 500 will have to reach 2,250 in order to qualify as a bubble. This fits with normal usage, as bubbles tend to follow a similar pattern. Prices pick up based usually on a genuine reason for hope. The canal and railroad booms in the 19th century, for example, or the internet innovations that were developed during the dot-com boom. Even the extraordinary spike in gold in the late 1970s, which is shown here in green for some reason, had a solid justification at the time. With inflation running in double digits, central bankers apparently set on turning both the UK and the US into a version of Weimar Germany, only with flares and disco beats. As investors bet on transformative change, prices eventually rise well above anything that can be justified. Fantastic profits being made suck in more and more money. But bubbles don't have to involve major innovations, as the 1929 boom showed. The Dow, on here in red, soared almost fourfold in 5 years, virtually identical to the performance of Japan's Nikkei 225 during the debt-fueled property and everything else bubble of the late 1980s. Now, Edward Chancellor, who's author of A History of Speculation, goes rather further in his definition. As well as price, he looks for 3 other elements: evidence of fraud, obviously unrealistic expectations driving prices, and easy monetary conditions. Fraud and bubbles used to be synonymous, with the South Sea bubble really meaning the South Sea swindle. That's no longer the case, as bubbles now mostly used to mean speculative excess. But there's no doubt that speculative excess does tend to be associated with lots of bad behaviour. That was shown both in the aftermath of the dot-com bubble and in the years that have passed since the 2007 credit bubble popped. This chart shows a fairly standard pattern that prices follow. The Nasdaq, on here in red, shows the dot-com bubble, which was the biggest bubble of recent years. Against that's oil in the 2000s, that's in green, which came close to being as extreme as the Nasdaq. And I've also added in blue what may one day come to be seen as the biotech bubble of 2014. Unless, of course, this time really is different and we don't get a bust. Now, as each boom went on, it became more and more extreme, with the near vertical price rises that came towards the end showing the stupidity of what was happening and the rush among panicked investors to try to buy in. A serious level of worry about what they were missing out on. The ideal way to invest during a bubble would be to be fully in the market right up until the moment that it's just about to burst. Unfortunately, timing the top is all but impossible, which creates twin risks for investors. They might get out too early and miss out on lots of future gains, or they might get out too late and lose an awful lot of money as the market crashes. Some investors get around this by betting only on bubbles which come with an inherent time limit. Jim Chanos, who runs short-selling hedge fund Mackintosh, looks for what he calls booms which go bust. These are bubbles financed by debt, which can't continue forever because the interest costs in these booms are higher than the underlying assets supporting the debt can generate. Now, shorting these types of booms from dot-com era internet backbone providers, companies like WorldCom, through the subprime bubble to his bet today against China, does reduce somewhat the risk inherent in equity finance booms that they may simply just keep going up. Now, bubbles create a dilemma for those who are merely trying to make sensible long-term investments, particularly when the bubble spreads across many assets. Staying in the market runs the risk of sharing in a disastrous post-bubble collapse, creating the sort of losses which prompt many investors to give up on entire asset classes for years. But avoiding the market can be even worse. Fund managers have a problem that they destroy their careers if they bail out of a bubble too early on. Investors less worried about career risk might think they have little to lose by staying on the sidelines. Sadly, few have the willpower to stay out for long when their friends are all minting it in extreme price rises like we see on here. That creates the risk of being a late convert to the "this time is different" argument. And if that happens, you may end up being one of the mugs who buys in just as the top is approaching.